You're watching Beyond Markets. Welcome, I'm Kenneth Igbomo, and on today's show, we'll find out what the International Monetary Fund expects for Sub-Saharan Africa with IMF's mission chief to Nigeria. You can join the conversation with the hashtag Beyond Markets and also follow my handle at Kenneth Igbomo. Now, IMF's mission chief and senior resident representative for Nigeria, Amine Mati, says for inclusive growth and to reduce the vulnerabilities of the economy, Nigeria needs a comprehensive, coordinated package of measures, and it is important for Nigeria's monetary policy to remain tight to check inflation. CNBC Africa's Esther Awoniyi caught up with him and started the conversation by asking about the regional economic outlook.
3.2% for this year, same as last year, and then projected to increase to 3.6% in 2020. And what's new is that it has increased, but compared to our original forecast, this was a downward revision. And because they were facing global risks, actually we revised our forecast down for 2/3 of our countries. Nigeria was not one of them. And the reason for that is that the downside risks from trade tensions, from tighter financial market conditions, or even fluctuations in some commodity prices affected the countries in the region. And the story is twofold. It's not a uniform story. There's a lot of heterogeneity. And we can see it here in some of the countries that are natural resource countries. Those have been growing at 2%, 2.2%, and some of them in negative per capita terms or flat. Whereas some of the non-resource intensive countries, those are all importing countries, the growth pattern is different, it's 6%. And so if just to give you an idea of the dynamics here, for that first group of countries where we see per capita income higher than world levels and where we see growth picking up with higher rates, and here these are Ethiopia, we see Ghana, we see Kenya, those countries are about 25 and they represent about 500 million people. The other side is 700 million people of the 1.2 billion in Africa being affected by a lower growth rate, including Nigeria, where negative per capita term is there, and of course Nigeria representing 200 million people.
Now, what about outlook? What does the report say about the outlook for inflation?
Inflation for some of the countries, I guess, it is on the rise for some. There's been progress in inflation declining over the past year, but for some countries have seen pressures from commodity prices, from supply shocks, and others have not. Again, this is not a uniform story, and also it will affect what will be the policy response. Those that have more room on growth or inflation can maybe use monetary policy or fiscal policy depending on where they are in the cycle.
And speaking about monetary policy, the report did highlight that the growth outlook relies on continued support for monetary policy, especially those in countries, monetary policy in countries that have independent monetary policy. And just that makes me think about Nigeria and all the support we've seen from the monetary policy authorities here. Just shed more light on that point for us.
When the report talks about monetary policy, it talks about monetary policy depending on where you are in the cycle. So some countries have very low inflation, have their debt level under control or sustained, and therefore they have more policy levers that they can use on both the monetary side or on the fiscal side. And obviously, if you have more flexible exchange rate system, this is where monetary policy or changes in interest rate will be more effective. And that's what we are recommending for those countries that have rooms. And you have to look at it from inflation, growth, balance sheet, where is your country situated, and this is where you know which policy levers you have available to try to promote growth, or if you are vulnerable, maybe build buffers for a time of a downshock.
Now, we know that there's still, especially on the global front, which are also impacting on or adding to the downside risks here, the global trade, the trade wars, the tensions, protectionism, etc. I'm just wondering, for sub-Saharan Africa, what is to be said about the state of competitiveness, across the region, and how many of these countries are able to attract private investment? We're seeing annual budgets, being constrained, debt levels are rising, including here in Nigeria also. So obviously there's pressure on revenue, especially mobilizing domestic revenue, and of course there's been that increased call for private sector engagement, that handshake between government and the private sector. What is to be said about level of competitiveness and investment?
We have a chapter in the report looking at competition in the region, and what we found is that competition in Africa is relatively low. We still have also, for example, this was measured in terms of markup, in terms of the markup pricing, and we've seen that the markup pricing on price of some of the goods have been increasing in some countries, including Nigeria and South Africa. And why is better competition better for those countries? Because better competition will improve growth through higher export growth, higher productivity, and more labor productivity. And we've done an analysis in the report. If you were to look at the regions, growth per capita is 1%. If you were to increase the level of competition to the level of the 75th percentile globally, that 1 percentage point goes to 2%. And therefore, you're doubling your GDP per capita, which is not insignificant. And let me just give you a perspective here why it's important. Today, coming to the job market, we expect that by 2035, 20 million new entrants are coming to the job market. Today, in Africa, we are only creating 10 million jobs. Therefore, you need 10 million new jobs being created just to keep up with the new labor market entrants. Hence the importance of growth and where competition can come in trying to create some of those opportunities, which includes better regulatory environment, a proper competition policy. Those are part of some of the recommendations we are delving into in the report.
Okay. I want us to quickly go over to, there was an IMF staff visit in October this year to Nigeria. I'd like us to just quickly talk about that visit and some of the, I know that you met with Nigerian officials, just looked at the state of the economy, growth levels, and some other economic variables. And I was just taking a look at your conclusion, the staff conclusion based on the meetings and what you'd seen. And some of the conclusions that you drew were, among them, there's still slow economic recovery is continuing. But more importantly, you did say that a comprehensive package of measures is urgently needed. Could you just shed more light on that?
On the outlook on the comprehensive package?
On the comprehensive package of measures.
To try to push growth and have a growth that is more inclusive and reduce at the same time the vulnerabilities of the economy, including on the external sector, I think our recommendations is that you need a comprehensive, coordinated package of measures that includes fiscal consolidation driven by higher non-oil revenues, and oil revenues are there, so they should be sustained, but they depend on external factors. And we know in Nigeria, non-oil revenue is very low, one of the lowest in the world. There are steps taken, like the new finance bill, to try to increase some of the revenue. So that's one, and those revenues are needed to create the space necessary for priority spending, including to push up capital spending, which is needed for growth. At the same time, to have sustained growth, we believe that it's important that monetary policy remains tight, and so that you keep inflation in check. And with inflation low, it will help growth be maintained or grow more sustainably over the longer term, including because you have then investment coming in. It's also easier to get lower rates, which will also be easier to get lending in the economy and private sector activity up. And that's when rates are lower. Now, the third point was to make sure that we have unified and market-determined exchange rate that can respond to shocks and that will remove some of the existing distortions, but also encourage long-term investment. And then the fourth, last but not least, is structural reforms. A lot of those structural reforms are part of the government plan in the Economic Recovery and Growth Plan, and those will include solving the power sector, improving or moving on governance, and also on moving further on doing business. There's been quite a lot of progress made. This year, Nigeria moved from to 145 to 131, coming from 169 3 years ago in the World Bank rankings of doing business. And I think proceeding on these reforms would be important to also make sure that the private sector remains an engine of growth. And it has to be comprehensive. There's not just one panacea. So that's why we keep talking about working on all those measures.
But would you say that for the structural reforms, especially on key sectors like power, yes, we're seeing better numbers with the doing business as shown by the World Bank, but key metrics like power that actually move the needle. Would you say that those reforms, the pace is still slow? Would you say that the pace is still slow and that's why we're not seeing the kind of traction that we need to see?
I would say that reforms are progressing in those areas. Remember, we used to have that power generation was 5,000 megawatt. Now we're at 7,000, and the issue has been more on distribution. And there's work ongoing in the power sector recovery plan on trying to fix some of the issues in this area, including dealing with previous tariff shortfall, making sure they can secure the funding, and then making sure that the system is sustainable longer term, which would include not the easiest solution, which is cost-reflective tariffs, making sure that all the bills are paid, also following the performance improvement plans of the DISCOs. All of that are part of the strategy that I know the government is working very hard on, including more recently with the World Bank and others when they were in Washington. And I think now there's a plan being worked on with all stakeholders to try to address the issues in the power sector, which is listed as the number one constraint to doing business in Nigeria.
Now, in your engagement or conversations with the government officials, when talking about the budget, and especially the 29, we know there was a carryover from the previous year, and that we saw more spending. But revenues, there's still pressure on the revenue, and I know that, like you said, the finance bill will help. But are you still? What are your areas of concerns regarding?
Last year, actually, we're still this year in 2019. In terms of budget execution on both, the current spending has been on pace, close to 100%. Capital spending, we've seen 1.1, 1.2 trillion till September, likely to be about 1.7 trillion naira for the year. And where throughout the year, the difference with the budget has been seen is really on the revenue side. Revenue shortfall, including on both the oil side, on some of the projections that were expected coming from PSCs and others, and on the non-oil revenue. And the consequence of that for 2019 has been that the financing of the budget, because the spending is really a hard target, you needed to do some of that spending. In Nigeria, needs to spend on salaries, on capital spending, also on the interest payments. And therefore, to cover that shortfall, there was extra financing that was needed. Given that there was already a hard limit in the budget on the financing on domestic and external, the difference compared to the previous year was really that a lot of the financing has come from the central bank. 2020, to your question, the budget this year has been done with, for 2020 with more realistic assumptions. And I think there's been a conscious effort to do that to avoid some of the shortfalls. Our view is that there's still some underlying measures to get to the revenue targets that probably still need to be detailed and see how to get there, notably on the revenue, on the surplus revenue for the independent SOEs and the oil revenue, PSCs, license bonuses. So those are discussions that will need to be looked at during the year in 2020 to make sure that the measures that are put in place are enough to meet the targets, and that so that if there's a shortfall, we don't get back to what happened in 2019. On inflation, we have to look at it of where we are coming from. 2017, we were at 18%. That has been decreased till like 15 months ago around 11%, 11.5%, and then has been sticky at about 11%. Then we saw the last 2 months some increase, 11.2, 11.6%. And some of that increase reflecting food inflation going back up, some linked to the border closure. We also see that core inflation has remained subdued, less than 9% at 8.9%. So core inflation is inflation without energy products and food products. Now, in terms of the inflationary, so how has the central bank been able to bring it from 15% to 11% is by keeping monetary policy tight. And we've seen money market interest rates higher than the policy rate. We know that the cash reserve ratio effectively was higher than 22.5, and therefore the central bank had different tools to try to keep monetary policy tight. And we've seen that on monetary aggregates. Reserve money up to August was growing at 3%, 5%. So that has been reduced. So that's the policy response that we have seen. Now, going forward, our views is that with the implementation of the 2019 budget accelerating in this fourth quarter, the festive season, which is a seasonal pattern, we have a VAT rate increase if the finance bill is passed. That will also put additional pressure on inflation. And so that would likely push up inflation and will justify keeping a monetary policy tight going forward.
Now, just your thoughts also on your perspective on some of the initiatives of the Central Bank of Nigeria. We've seen the Central Bank of Nigeria embark on a number of initiatives, and a lot of money is being spent in the process, especially targeted towards key sectors like power, but more importantly, the agriculture sector. The Central Bank is also supporting key commodities now, and trying to support farmers with cash, access to farm inputs and cheaper access to credit. Just your thoughts on and what analysts have been telling us is that the methods of the monetary authorities at this point are quite unconventional. But we've actually been seeing some results. We've seen interest rates come down. Of course, you're aware of the change of rules at the money market, excluding some participants from its open market operations and also from treasury bills. And we've seen interest rates, we've seen yields come down. So obviously, consequence for that for government borrowing costs, debt service, that's been a positive. But there's still that conversation around, there's still unconventional methods. We're seeing that blurred line between the fiscal authority, mandate of the fiscal authorities versus the monetary authorities. But I'd like to hear you, representing the IMF, what are your thoughts on these methods and the results that we're seeing?
I'll start by the end of your question by looking at these latest regulations saying that non-bank financial institutions cannot purchase OMOs. I just want to clarify that this is actually common in many countries where OMOs are used for liquidity management and usually bought by banks, some wholesalers, but is not open to all. Now, the consequence of that, given that a lot of those non-bank financial institutions were in this instrument, is that now they went to the T-bill market and the bond market, and we've seen bond yields falling 300, 400 basis, so negative in real terms. Consequence of that, if this is not mopped up, is that if there's a lot of liquidity that stays in the system, this may put pressure on inflation or could lead to higher credit, but also could lead to more imports and more pressure also on the exchange rates and reserves. So and this is why so far the central bank has always managed to mop up liquidity and keep monetary growth aggregates low to try to keep monetary policy tight in line with its inflation mandate. Now, your other part of your question about some of those interventions, our view is that those interventions are better done by the government and the fiscal authorities, and they should be appropriately budgeted and discussed as a priority, as these are spending, this is a worthwhile initiative that we want to fill the shortage in the power sector or help the agricultural sector, but it should be done by the government and then costed by the government as opposed to the central bank. What's happening is that given, we talked about the shortage, the revenue shortfall on the fiscal side. So to offset for that revenue shortfall, given that the limits on the borrowing were met, central bank provided the financing. So it was also a form of intervention. Also, it's provided central bank financing to the power sector. Then when that extra money was put in the system to try to keep inflation in line, central bank also had to mop it up using OMOs, right? So it probably would have been better if the government issued its own bonds and borrowed to pay for that, as opposed to having the central bank finance it and then have to mop up the liquidity.
Let's quickly move to the banking sector, financial system stability. A lot has happened there also, and of course, being done by the regulator, the CBN. We've seen the lending loan-to-deposit ratio going from 60% to 65%, asking banks to give out 65% of their deposits as loans, and it appears to have beginning to see some more lending. Credit to the private sector is up, according to data from the CBN. Credit to the private sector up 13.8% in October from around just over 12% in the previous month. Your thoughts on that, this particular method, and the fact that these banks are now, perhaps, I don't know if to say having a greater impetus to lend, but obviously regulation, they have to comply.
I haven't seen the decomposition of the loans, but I've read the same MPC that was communicated that detailed that with an increase of 1.1 trillion naira since May. Some of it into manufacturing, some of it into retail. The concern, if there is a concern on these loan-to-deposit rates, is how are banks lending? Are they lending to those sectors while keeping the right risk standards when they evaluate the credit? We don't want to end up with a higher NPL. So far, the communiqué has mentioned yesterday that NPLs have gone down to 6.7% of total loans. But are banks now afraid of sanctions going to take more risks? And then we'll end up with a higher NPL, which then is a problem because it will lead to more recapitalization and others. Also, the funding structure could be affected because some of those banks may try to reduce the amount of deposits they're getting to try to meet the ratio, or try to refund some longer-term liabilities, which is part of this deposit lending to deposit ratio. But I want to come back maybe to another question. When we talk about monetary policy, we should not talk about it in isolation from what's happening in fiscal.
Okay.
Because if the financing needs of the government were reduced, for example, through higher revenue, then there will be less need to borrow. There will be less need to issue government bonds. There will be less need for the central bank to inject money and have to mop it up. And therefore, there'll be less government bills and less CBN bills available for banks to lend, for banks to acquire, which obviously they will acquire because it's high yield, risk-free, and why take the credit risk?
Yeah, but the fiscal authorities appear to be between a rock and a hard place now. I mean, they have a huge wage bill. Looking at what is spent on recurrent versus capital expenditure, there's still that huge imbalance. And we don't know if that's going to, when that shift is going to happen significantly, at least in the near to medium term. So that is what the government, the fiscal authorities are dealing with at this time. So.
True, and we've raised this concern in the past in terms of interest payment to revenue. That represents 60%. Hence, again, our advice about the importance of increasing revenue. And that may take time, but some revenues, on excise, removing exemptions or broadening the base could come in much earlier. And let's not forget that you also have recourse to external financing at appropriate rates, which would then not crowd out the private sector credit domestically.
Okay. Well, your outlook, I know that there's already an outlook 3.2%, but just the totality of all the policies that we're seeing, some, like, for instance, the border closure. I know that the mixed views on the border closure and with the Africa Continental Free Trade Area, how that makes what that says about Nigeria's commitment to the Africa Continental Free Trade Area. But just the totality of all the policy and the policy responses, would you say that after all is said and done, that Nigeria is on a path of growth and that perhaps we're seeing a faster pace in that regard?
Let me just clarify, the 3.2 was on the regional front. For
Oh,
Nigeria,
okay.
We are 2.3 for this year, and for 2020, we're projecting 2.5%. Under current policy, which means that oil production is still at 2.05 million barrels a day at 2.1. Agriculture is being strong, and some of the non-oil, non-agricultural economy is still growing at about 1.8%, 2%. It's a positive growth rate, but still in per capita term is still negative. And pursuing these reforms, so for example, these are under current policies, but if the power sector reform moves on, or some of the clarity of policies, there's an economic recovery and growth plan. if there is a long-term announcement of what are the policies that are going to come in, then you're going to get some of the long-term investment coming in, and that could boost growth even further.
And that was IMF's Mission Chief and Senior Resident Representative for Nigeria, Amine Mati. And that's it on Beyond Markets, and thank you for joining us on the show. Remember, you can watch the show at 5 p.m. West African time daily and have access to all previous episodes of Beyond Markets on our website. That's at cnbcafrica.com. You can also stay engaged with the hashtag Beyond Markets and follow me at my handle. That's at Kenneth Igbomo, and have a wonderful day.